But since we have a quorum, why don't we just go ahead and get started while we wait for the Zoom to get set up? Sound good? All right.
Sounds good.
So I don't know if item 2 is the reporting on the quarterly invoices. If there were any questions, that's really just for us to continually monitor. There's no action needed, but were there any questions? No? Okay.
No.
So then if we move to 3, we have for both the town and the police, we have some retirement and refund applications. Tony, I know you always review them.
I did review them, and I was able to match all of the calculations. We have a whole bunch of them that haven't picked their survivorship or picked whether they want a retirement or two. But all of the numbers I've matched when they get around to getting that settled.
Okay.
For both the police and the town.
Enter
Okay,
your meeting
wonderful.
ID, followed by
Then if
pound.
there aren't any other questions from any of the other members, do I have a motion to approve for the town?
I move.
Tony moves for the town. Do I have a second?
I'll second.
Right, seconds. All in favor for the town?
2, 3,
Great,
7.
unanimous.
This
And
meeting
for the
ID
police,
does not exist.
so moved, Kim
Please re-enter
moves. Do
your
we have a
meeting
second?
ID.
Kevin, all in favor? Great, unanimous. Those are all approved.
Enter your participant ID, followed by pound.
The meetings were at the back
Otherwise,
of the
press
packet.
You are in the meeting
Were there
now.
any questions
There are
or any
4 participants
items
in the meeting.
that
You
people
are
had questions
muted.
about or
You
wanted to
can
call
mute or
out?
unmute yourself by pressing *6.
No? Okay. Do we have a motion to approve? Yeah, for police.
You are
with,
unmuted.
Kim. Second.
Good morning, good afternoon,
Actually,
guys.
you
Is this
don't have
Boston
a quorum with
Partners?
this, because Kevin has to abstain since he wasn't.
yes, I do.
So-
Yes.
Hi, guys, hold on. This is Karen. We're just about to start. Bear with me for one moment.
Sure, no problem.
Keep going.
Okay. If not, we can
Apparently, I
also-
need to redone them.
We could try this.
I
We have a
move.
motion for Tony to approve the minutes. Do we have a second
I'll
for the
second.
town?
I hope somebody's
Craig,
taking good
all in
notes.
favor? Great. Here, I'll mark who.
Thank you.
Welcome to Zoom. Enter your meet.
We don't have quorum for the police, just for the minutes, so. that's fine.
Enter your participant ID. You are in the meeting now. There are 4 participants
I'm back.
in the
There we
meeting.
go.
You are muted. You can mute or unmute yourself by You are unmuted.
John and Kara, are you there?
Hi, yes, we're here.
Okay, little operator error
Yeah.
on my part. Hold on one moment. I'm going to turn it over to Kelly, who's far more able to do this.
Thank
There we
you
go.
so much. All right. Okay, so John and Kara, hello, thank you. Sorry about the technical difficulties in getting started. John, I hope your wife is doing well.
Yeah, she's back home and resting comfortably. It's hard to get her into bed, but she's there right now, so I'm happy for that.
Wonderful. Glad to hear it. Well, we are all here and we received your materials, and so if you'd like to jump in with an update, we'd love to get started.
Great. Yeah, and appreciate the last minute change of plans and looking forward to an update. So I'll start briefly with the firm and team update, and then I'll hand it over to John for the performance update. But of course, as always, please feel free to jump in and ask questions at any point. So starting on page 1, just in terms of the firm and the assets, we ended the quarter at about 89.6 billion. That's up slightly from about 88.6 billion at the end of March. Positive effects of market movements offset by some marginal outflows across our strategies. Premium equity, which you are invested in, ended the quarter at about 10.9 billion, down just slightly from 11.3 at the end of the first quarter. Similar story there. Generally across the firm, the profile looks similar from what you saw last quarter, and I'm sure you're familiar with. We saw some marginal inflows in some of our emerging markets and international strategies, and some marginal outflows in our large cap and all cap strategies in the U.S. Flipping over to page 2, in terms of the team, again, a very boring update to report. Really no changes to the portfolio management team. Julio Romalo continues to manage the strategy. No changes to the fundamental or quantitative research teams. A very stable team in the quarter. We added one trader in the quarter, Steven Ferreira. He joins us, an experienced equity trader, so we're excited to have him. And no other updates. So unless there are any questions, I will turn it over to John.
Does anyone have any questions on the firm? No, I think we're good to proceed.
Okay, well, thank you, Kara, and thank you just to the board for giving us the flexibility to be able to present by phone here. We love to see you, and sometimes the world doesn't allow you to be where you want to be. So, again, thank you very much for giving us the flexibility here.
No problem.
On page 4, you can see the performance on page 4. You can see overall the fund was up about 2.2% on a net of fee basis, compared to 50% of the Russell 3000 value and 50% of the Barclays U.S. Aggregate Index. We beat the benchmark by about 57 basis points. If you use the S&P 500 as our benchmark, we lagged by about 170 basis points for the quarter, as we are once again in a what I call a go-go growth market where investors are kind of ignoring valuation and chasing the theme of the day. And the theme of the day looks like it's artificial intelligence and ChatGPT. So we'll see how long that fad lasts. Certainly it's a powerful technology, but way too early in the stages to be able to bet on who the winners and losers might be as a result of that new technology. On the equity side, on a net of fee basis, we returned about 4.46%, outperforming the Russell 3000 value benchmark by about 43 basis points. That was up about 4% for the quarter. Fixed income was pretty much right on line, a few basis points behind the Bloomberg Barclays Aggregate Index, with the BlackRock Bond Fund underperforming a bit and the Vanguard Bond Fund outperforming a bit. But all in all, a solid quarter from our primary benchmarks, beating our value index and our preference for equities over fixed income also paid off modestly for the quarter, as equities did outperform fixed income for the quarter, with fixed income having a modest negative return. On a year-to-date basis, on the equity side, we're catching up relative to the Russell 3000 Value Index, but still lag that benchmark by about 1% on a net of fee basis, while the fixed income portion of the portfolio is about equal that to the benchmark on a net of fee basis. Again, compared to the S&P 500, which has been up nearly 17% this year, we have not been able to keep pace with that benchmark on the equity side due to the factors I mentioned earlier. Lots of numbers on this page. I just want to take a breather here and see if there's any questions on performance for the quarter or year to date or any other time period.
No, there are no questions here.
Okay. If we turn to page 5, you'll see a page that looks very similar to the previous page for the police, I believe, right? Yes, I'm sorry. Yes, for the Town of Darien Police, and you can see the only difference here is the inception date. I think it might be slightly different, but aside from that, you'll see very similar returns for that portfolio, as well as they are clones of each other, so we manage them together with the same holdings, as you know. On page 6, there is a little bit of news to report. For a very long time in that low interest rate environment, we had been at the maximum exposure of equities in the portfolio. With the recent move of bond yields, particularly on the short end, approaching or even over 5%, we've seen fixed income look a bit more attractive. And as fixed income underperformed this quarter, we took the opportunity to add a little bit to the fixed income portfolio, take a little bit away from the equity portfolio. We are now at about 56% equities and about 44% fixed income, which again puts us at about the 75th percentile of where we could be with equities versus fixed income. So still overweight equities, but less so with the more attractive yields in the fixed income market today. And we've seen on a year-to-date basis, somewhat surprisingly, the equity market has outperformed the fixed income market so far this year. But of course, with greater volatility as you would expect in the equity markets versus fixed income. Page 7 shows the assets that we currently manage for you and for your beneficiaries. For the Employees Pension Fund, we can see that you currently have a balance of about $101.8 million. And you can see initially you gave us about $26 million. You've taken away about $4.4 million over that time period for net investment of about $21 million. That $21.5 million investment has now grown to over $101 million, almost 5 times your net investment. The police is almost even more of a head scratcher, where you initially gave us about $23 million. You've taken out about $22 million for benefits and other uses during that time period for a net investment of about $1 million. And that $1 million today is equal to about $57.6 million today in the portfolio. So very nice returns. Overall, between the two portfolios, you have a net investment of about $22.6 million. And today, the total of both of those portfolios is about $159 million, or more than 7 times your net investment. So those are certainly the benefits of sticking with your convictions over the long term, sticking with us as a manager, and also maintaining your investment in both the fixed income and equity markets over that time period. Any questions on the flows of the fund so far?
No, there are no questions.
Okay. Page 8, we can just see the OPEB trust, which we've been managing for you for almost 6 years now. And you can see the performance, which would be very much similar to the performance of the other portfolios for the last 5 years. And the total investment for these two funds together is about $11.2 million so far over this period. Page 9 is an interesting page to see the initial investment you made with us back in 2005, so nearly 18 years ago, or just over 18 years ago, I should say. With that $30 million has grown to about $174 million if you had kept the money in the fund on the equity side. And if you had invested in the Russell 3000 Value Index instead, you'd have about $114 million. So at least on paper, we've created about $60 million in excess returns for you on an initial investment of about $30 million over that 18-year time period. Again, this is kind of a paper portfolio because money comes in and comes out of the fund, and as you saw, the police took a lot more money out, but still has a significant amount of money left in their pension fund as well. A quick reminder on page 10, how we've created the excess returns for you since inception, looking at creating portfolio with the combination of lower valuation, lower PE ratios, higher free cash flow yields, strong business fundamentals, companies with high and improving returns on invested capital, and more profitable companies that are becoming even more profitable over time, and companies with positive business momentum, companies that are exceeding investors' expectations on a revenues, earnings, and then most importantly, a cash flow basis. Those are the attributes that we certainly believe create excess returns for our clients over the long term. There will be time periods, such as maybe the year-to-date time period, where lower valuation is not being rewarded in the marketplace, as investors are focusing much more on the potential for accelerating future growth for certainly just a handful of companies. And those time periods will last. We've seen it for a couple of years, from 2018 to 2020. We're seeing it now for a couple of quarters this year, but those time periods typically don't last very long. On page 11 in the presentation, we can see how the current portfolio is positioned within those three circle characteristics. In the valuation circle, the second ratio down, PE FY1, the portfolio trades at a very reasonable 12 times earnings. Compare that to 18.4 times for the S&P 500 and 13.6 times for the Russell 3000 value. So certainly a less expensive portfolio with a much higher free cash flow yield. Really double that of the S&P 500 at this point in time. From a fundamental standpoint, very strong profitability in this portfolio with high operating returns on assets and returns on equity relative to the value benchmark, and nearly matching that of the S&P 500, despite the fact the portfolio is trading at a significant discount to the valuation of the S&P 500. So certainly creating a less expensive, high-quality portfolio with very positive business momentum, where 84% of the holdings of the portfolio have met or exceeded earnings expectations in the most recent quarter. So, again, those are the characteristics that have been in your portfolio for 18 years and hopefully will be in your portfolio for the next 18 years as well. On page 12, we can see the capitalization breakdown for the portfolio relative to the Russell 3000 value. As you know, this is an all-cap value portfolio, and we will shift the portfolio weights between small, mid, and large cap, depending upon where we are seeing opportunities on a bottoms-up basis. You can see the green portion of this slide is much broader in your portfolio relative to the benchmark. We are about 12% overweight mid-cap names in the portfolio today, where we're seeing very good valuation relative to large cap, and certainly don't see the volatility that you often will get with small cap stocks. We need to see small cap stocks, which are attractive today, become even more attractive on a relative basis for us to probably dip a bigger portion of the portfolio into that market cap spectrum. But in general today, when you look here, you'll see that we're underweight large cap relative to the benchmark, a bit underweight small cap, and overweight mid cap in the portfolio. On page 13, we can see how the portfolio is currently positioned today. We've got the top 10 holdings, about 18% of the portfolio is in the top 10 holdings. As a reminder, this is a fairly diversified portfolio, currently with about 122 holdings overall in the portfolio. We like to own more companies rather than less to create those characteristics of the portfolio that we believe will outperform. No matter how much homework we do for you, there's always going to be some unexpected announcements which could adversely affect some of our holdings. We want to make sure that we have a diversified portfolio so we can absorb those adverse events in the event that they happen. And typically we get a handful of those every year. In the lower left-hand corner, you can see that the average rated market cap of the portfolio is below that of the Russell 3000 value. Again, as I said, we are overweight the mid-cap portion of the market. Turnover in the portfolio has been relatively modest, meaning on the low end of our expected range of about 20 to 40%. Been about 20% over the last year, only about 3% in the last quarter, as we've been very happy with our holdings in the portfolio relative to expectations. We're really seeing very good valuations and not seeing really a lot of opportunities to trade out of our current positions. On the right-hand side of the portfolio page, you can see how we're positioned relative to our benchmarks. As you go down the right-hand side of the page, you can see areas where we are underweight relative to the benchmark, including consumer staples, real estate, and utilities. Very little participation in those sectors as those areas look relatively expensive to us. Very low returns on invested capital for some companies such as utilities, and very expensive for some areas such as consumer staples and real estate. We did have an opportunity to add to some consumer staples names as they have underperformed so far this year. We added to Kenvue in the portfolio, perhaps a name that you're not familiar with. Johnson & Johnson's baby powder and Band-Aids and Tylenol, very well-known brands. Johnson & Johnson has spun that out into its own separate company, and it looks like an opportunity for some good earnings momentum from that company at a reasonable valuation relative to other consumer staple stocks going forward. So we've added that to the portfolio. Johnson & Johnson will be spinning out the rest of that company by the end of this year. Right now, they've floated about 20% of the market cap of the company to public shareholders. Technology is an area that we're overweight in the portfolio. We've been overweight the semiconductor area since about the third quarter of last year. We made an investment in Advanced Micro Devices, where we've gained about 40% in that position since our purchase last August. We have sold it out because it reached our price target. This is a company that also got swept up a bit in I call it the craze, or the focus on artificial intelligence. They certainly make some semiconductors that are used for artificial intelligence uses. Made the stock soar beyond our price target. While we like the opportunities there in AI, we don't want to suspend our valuation disciplines to continue to own that stock. So we have sold out of that position. And then healthcare is an area that we continue to be overweight. We've spoken about that in the past. Health insurance, pharma, and established biotech companies are big positions in the portfolio. Quite frankly, they haven't done all that well this year. Not really due to any fact of their own. It's just more of that investors have been a bit more focused on technology companies this year and not as much focused on healthcare. We continue to see very good opportunities there going forward. And then finally, I'll just make a quick comment on financials, where I think we spoke about our exposure to regional banks, which we had been overweight during the first quarter. We sold out just about all of our positions by the end of the first quarter. The one tag-end position that we had in Huntington Bank shares was sold out in April of this past quarter. So we currently have no exposure to the regional bank area in our portfolio as we expect there to be continued deposit flight out of those regional banks, and then also potential commercial real estate write-off as commercial real estate is a bit under stress these days with many folks working at home and less occupancy in many office buildings. I'm going to take a breather there and see if there are any questions on the positioning of the portfolio.
Are there any questions for John? No, John, I think we're good with the positioning.
Okay,
Yeah.
great. Pages 14 and 15, you can see the current holdings of the portfolio. I'll let you peruse at your leisure. Just a couple of concluding comments on the performance we've created for you over time. On page 16, we've measured ourselves how we do in months when the market is down and months when the market has been up, and you can see we're pretty well balanced, outperforming in 61% of the down months and 56% of the up months over the last 15 years, for an overall batting average of 58%. 58% are pretty good odds if you could walk into a casino with those odds. And you can do pretty well in the equity markets if you're correct 58% of the time as well. And you can see on page 17 how that compares to some of the competition out there. Our returns for the last 15 years rank us in the 9th percentile of all cap value managers. Our information ratio, which is our risk-adjusted returns, puts us in the 1st percentile. We take less risk than most all cap value managers with our diversified approach. And then that batting average of 58% that I showed you earlier also puts us in the 1st percentile. So strong outperformance on a consistent basis. That's our goal for not only our relationship here today, but with all of our clients. On page 18, you can see how our performance looks on a rolling 3-year basis relative to our benchmark, net of fees. You can see over the last 15 years, average outperformance has been about 2.3%, outperforming in 78% of the months. again, consistent outperformance. And if you look at where we are today, we're at the top of the 2.5 to 4% column in the green on the right-hand side. And it's just interesting to note that we have never been 2.5% to 4% behind the benchmark on a rolling 3-year basis. The most is in that 1.5 to 2.5% range during 2012 time period. So again, strong performance historically, and hopefully we can keep that going for you. And also hopefully we're beginning to see evidence of a broadening of the market that seemed to have started around June. We're only 6 weeks into it, so that does not yet make a trend. But if we do see a broadening of the market beyond 10 stocks that have led the market so far this year, that would be good for certainly our style and showing that investors are once again paying attention to valuation.
And John, as you look ahead, you commented that on the asset allocation with fixed income looking a little bit more attractive, you took the opportunity to add in the second quarter. So can you just share can you expand on your comments in terms of your outlook and what you're seeing for, this is the end of our fiscal year, so as we enter into our new fiscal year, sort of what your outlook is?
Sure. So when we look at fixed income and we evaluate that, seeing the short end of the curve being in the 5% range, with the Fed not appearing to be cutting rates anytime soon. When I say anytime soon, kind of mean towards the end of this year. Mm-hmm. We certainly expect them to raise rates in a week when they have their next meeting. They will likely take a bit of a pause after that, but if they were going to move 50 basis points from that position by the end of the year, we would certainly bet that it would be up rather than down. So, with short-term rates being 5%, it doesn't seem apparent to us that we should be overweight equities to a maximum extent. Okay, I'd say the equity market has certainly been stronger here over the last 10 months than most people would have expected. If you turn to page 25, just give you a little bit of an idea of what's happened in the equity market. And if you look at the top line, the CPI year over year, at 9/30/2022, the CPI was about 8.2%. At the end of the first quarter, it was about 5%. We've updated this page since we sent you out the book last week, so I apologize for that. But as of 6/30, CPI is about 3% right now. As inflation has come down, the multiple of the market has expanded. The S&P 500 PE FY1, which is the second to bottom line in the table, you can see the PE multiple of the market bottomed at about 15 times earnings at the end of September, currently about 18.4 times today. So still below that of 2022, leads us to believe if inflation continues to come down, and if 10-year bond yields and the Fed eventually cuts rates over the next, say, 2 years, that we could again see some additional multiple expansion in the market. So it's, I guess, a long-winded way of saying I think we're in a pretty safe place with equities, despite the fact there's been very strong returns. And when we look into 2024, it's a bit of a flip of a coin right now. Will we avoid a recession in 2024, and therefore earnings expectations should rise? Versus, the recession that many folks have been calling for, has that just been pushed out to 2024? It's kind of too early to really have a conclusion there, but if we do have a slowdown, we don't expect it to be a longer, protracted slowdown, certainly not one nearly as long and deep as the one in 2007 to 2009, and certainly not one as sharp as we saw during COVID. So we think that the market would probably be disrupted for a little while, but not one that would be a terrible event for the market if you look over a 6 or 9 month time period. So all in all, the outlook for equities we still think looks positive. There's certainly some question marks out there, as there always are. we feel like we're in a position over the next 12 months where we should be expecting positive returns in both the equity and fixed income markets going forward.
Great, thank you. Does anyone else have any other questions for John or for Kara? No? I think we are, we don't have any questions, John. I think we are in good shape, unless you had any closing comments.
Closing comments would be thank you for the 18-year relationship, and we continue to want to meet your expectations, so let us know how we can help going forward.
Wonderful, thank you. We
Yeah,
appreciate the update.
Looking
Sorry.
forward to another quarterly update in October.
Wonderful, thank you so much. We appreciate the update and the long relationship and the returns that you provided for the both plans. And enjoy the rest of your summer.
Thank you very much.
All right, thank you.
Are they all? Can I just ask a question about page 16?
Yeah.
They always trot that out, and I get we want to outperform on down and outperform, but couldn't we like have a really bad quarter and it gets wiped out? I mean, there's that, it doesn't have a, what's the word I'm looking for?
So on page 16, they're just showing
Yeah.
I mean, you could have,
Oh, a wipeout.
yeah, but their risk management process is one where
Keeps us in a fairly narrow band.
it does,
Okay,
yeah.
'cause it was,
Yeah.
I'm like, well, yeah, but unless we hear, see what the numbers are, that's a little, okay.
Yeah, I mean, if we went through and we looked at all of our monthly returns, they're really just comparing it to the Russell 3000. And if the Russell 3000's down 10, but they're down 9, they're crediting
No, oh,
themselves.
no, I got how it all works.
Yeah, okay. So, yeah,
Yeah,
so.
no, I got it,
It's
just.
a win.
Well, yeah, I think page 18 would show you the monthly negative returns and positive returns.
Over a 3-year, it's a rolling 3.
Yeah, but
Yeah.
without saying what the downside, what, yeah, I get it, it's,
Yeah. They have, I mean,
yeah, it's fairly, it's, that's the answer, which is,
yeah,
There's
it's their
never
risk
a real-
management, and they actually don't
Totally
take,
not.
if you look at the sizing of individual names, because that's really where you're gonna get the big potential blow-ups, that's where it won't affect the entire.
Like, yeah, you're dealing with a 122 stock portfolio, and they're not at the risk,
Yeah.
they're talking about
That's the
pretty
only-
mundane.
Well, and that's, actually, the plans have really benefited from that over time. If you look at just their returns, and you think about our return assumption and the support that the town has always given with funding the plans each year, it's just put us in a very healthy place.
we are.
And that eVestment universe comparison is, which I think was on page 17 or something around there. It was near page 17. They're in that top decile, which is,
Where
which is
we need to
really
be.
strong. So,
Thank you.
yeah. Okay, I know we went a little bit out of order, so ending with the investment report, it does not leave anything else on our agenda unless there was something else that I missed.
Now, if you wanted to, I have written here no forum for the minute review, so.
Oh, that's great, yeah, because we actually did it for the town, but it's just for the police to approve for the.
So moved again.
Okay, so Kim so moves, do we have a second? Mike, and all in favor for the police? Wonderful, all right, and Kevin abstained.
catch.
Best, thank you. So that concludes everything on the agenda. Do I have a motion to dismiss?
Move to adjourn.
Okay, Tony moves to adjourn. Do I have a second? All right, Mike, second. All right, wonderful.